Ladies and gentlemen, you are connected to the NOCIL Limited earnings conference call. Please stay connected. The call will begin shortly. Participants, you are connected to the NOCIL Limited earnings conference call. Please stay connected. The call will begin shortly. Thank you. Ladies and gentlemen, good day and welcome to the NOCIL Limited Q3 and 9 months FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. S.R. Dev, Managing Director of NOCIL Limited. Thank you, and over to you, Mr. Dev.
Thank you. Good morning and very warm welcome to everybody present on the call. Along with me, I have Mr. Anand, our Deputy Managing Director, Mr. P. Srinivasan, our CFO, and SGA, our Investor Relation Advisor. Hope you all have received our investor presentation by now. For those who have not, you can view them on the stock exchange and company website. I hope you and your loved ones are safe and doing well. We will begin with the business update for Q3 FY23. Our operating revenue was rupees 326 crores for the quarter. As indicated during previous call, the business experienced price pressure during Q3 along with volume degrowth. There is a decrease in volume in the domestic market. Our export volume remained flat despite global recessionary trends. During the quarter, our customer offtake decreased owing to the inventory accumulation at their end. However, based on 9-month performance, our domestic volume remains strong. We see that both domestic and export volume will grow in Q4 FY23. The plus one strategy continues to be an important differentiator for NOCIL when our customers look for security of supply chain from a medium to long-term time frame. With strong appetite for growth supported by robust R&D and spare manufacturing capacities, we can address our customers' need to secure the supply chain. Based on the discussions with customers, we are quite confident that in the coming years, our export business will improve significantly from the current levels. Now, coming to the debottlenecking projects, our debottlenecking initiatives for some of our key products is on track and will be completed during FY24. The global economic scenario continues to be volatile, thereby impacting the ramp-up of existing capacity to optimal level. Similarly, on the new CapEx front, we continue to evaluate the global economic scenario, and at an appropriate time, we will take a final call on the CapEx. Now, I request our Deputy Managing Director, Mr. Anand, to provide an update on the industry outlook at our tire customer side.
Thank you, Mr. Dev. A very good morning to you all. To start with, let me give you an overview of the industry. Rubber applications, as most of you would know, is broadly classified into applications for tire and non-tire applications, with tire applications taking the lion's share in most markets, including India. The non-tire applications would include rubber applications for auto components, belts and hoses, cycle tires and tubes, footwear, etc. First, let me speak about the domestic market. NOCIL for many years continues to have a dominant position in both the tire and non-tire segments in India. The Indian tire industry, by and large, has about 30% of sales going to OEMs and around 70% for the replacement market. In the last couple of quarters, while the OEM segment has been doing well, the replacement market has not shown a similar robustness, leading to a mixed volume development at tire majors, with a few showing growth in volumes and a few degrowth on quarterly basis year on year. There has also been some lowering of inventory levels at the domestic level. A combination of lower inventory levels and lower demand for replacement tires has led to lower demand for rubber chemicals, thereby showing a negative volume development for the quarter on a sequential basis, but still positive growth on a YTD basis versus the previous year. As we work with our key customers on innovation, sustainability, and localization, we continue to secure our market share and are positive about increasing volumes in Q4 FY23. As far as international markets are concerned, as mentioned in the last quarter, we were witnessing destocking or lower stock levels in anticipation of a slowdown or the prevailing recessionary trends. This has led to some of our customers ordering less than before. The tire market in Asia has shown better resilience compared to Europe or the Americas. With the China Plus One strategy gaining further traction, and to a certain extent on account of the euro energy situation, NOCIL is in a good position to increase volumes in the export markets. Our export volumes in Q3 have been at similar levels as Q2 in spite of the unfavorable market environment. We are approved at most of the key tire plants of global customers, and as we speak, we continue to gain approval at more plants. We are positive of increasing our volumes in the coming quarters. That is it from my side for now. I will hand over to Mr. P. Srinivasan to give you an update on the financial performance.
Good morning, everyone. Thank you, Mr. Dev, Mr. Anand. Hope all of you are safe and in good health. Now let me run through the financial highlights, some key parameters. The sales volume for Q3 FY23 is 108 on an index basis, taking base of Q1 FY20 as 100. On a sequential quarterly basis, the volume registered a degrowth of 7.5%. As anticipated, as indicated earlier, domestic market impacted the sales volume on a sequential quarter basis. On the revenue parameters, net revenue for Q3 FY23 stood at 326 crores as compared to 389 crores in Q3 FY22. Net revenue from operations for the 9 months period April to December 2022 stood at 1224 crores as compared to 1109 crores in corresponding period of FY22. Coming to operating EBITDA parameters, operating EBITDA for Q3 FY23 stood at 37 crores as against rupees 50 crores in Q3 FY22. Operating EBITDA for 9 months FY23 stood at 200 crores as against 172 crores in 9 months FY22. EBITDA margin for Q3 FY23 stood at 11.2%, a drop of 160 basis points as compared to 12.8% in Q3 FY22. Coming to profit before tax, PBT for Q3 FY23 stood at 25 crores as compared to 40 crores in Q3 FY22. PBT for 9 months in December 22 stood at 162 crores as compared to 144 crores in 9 months December 21. On profit after tax parameters, the PAT for Q3 FY23 stood at 19 crores as compared to 30 crores in Q3 FY22. For 9 months December 22, it stood at 120 crores PAT as compared to 107 crores for the corresponding period 9 months of previous year. With this, we would like to open the floor for question answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Damodaran from Equitas Capital. Please go ahead.
Yeah, thank you for the opportunity. I hope I'm audible.
Yes, sir, you are. Please go ahead.
Yeah, so the first question is, if I look at your PPT, you have mentioned that the rubber industry was essentially flat for calendar year 22, whereas if I look at our volumes, they were sort of down 7%. And while the split is not available, but I'm presuming most of this decline is attributable to exports. So it seems we have lost market share, and this is sort of counterintuitive to the China plus one narrative that you've been hearing. So especially given the challenges that China has faced in the last 1 year, with COVID and everything. So just want to get your thoughts on that. How do you reconcile this? And a related question is, on the guidance front, can you give any guidance about growth relative to the industry's growth? If industry is growing at X%, what typically do you internally look at to grow? Is it X plus 2% or any such guidance that you can give? Those two questions from my side.
Yeah, so I think let me first speak about the export markets and your comment about market share. So like we said already, when we look at the export markets, clearly our volumes are more in relation to also where customer demand has gone down. We don't see an indication of loss of any market share in the export markets. Clearly, there's been destocking in the marketplace, and overall there is a sentiment of lower demand expected in the coming quarters. But that's the kind of sentiment that's played out, but not any loss in market share in the export markets. Another observation is that we are also present in the latex market, and that is a part of Southeast Asia and Malaysia, where there has been a significant drop in the rubber gloves market. And having presence in that market, that's also reflected in the export numbers. So if you really look at it, it's a combination of tire destocking as well as the latex market taking a nosedive, since the COVID abated. Your second, your other part of the question, can you just repeat that, Mr. Damodaran?
Yeah, sure. So with respect to any guidance that you can give with respect to your growth relative to the industry's growth, how do you look at that? If industry were to grow at X, how would you look at your growth? Should it be 2X? X plus 2% or X plus 5% or any such guidance that you can give?
Yeah, so like we have stated in the past, again, it's a correlation to our market share in the market. So if you look at the domestic market where we have a dominant share, we look to grow above market growth rates at least a couple of percentage points. Whereas international markets, I think that would not be the metric. We would look to grow significantly, like you said, X, but difficult to put a number to it because we have a low market share in the export markets.
Sure. Okay. And just one last question from my side. If you can give out, what was the growth in export and domestic volumes over 9 months?
So I think if you look at the growth in the domestic market, we have 7 to 8% growth year to date. The domestic market. The export markets we have not seen growth. Yeah, so that's why we say YTD there's not growth. It's only from a quarter to quarter that we see it's flat.
Okay, sure. Thanks.
Just to add a bit, this is Srinivas here. In export market, as Mr. Anand just referred to, the latex market degrowing. If you see the latex market rubber consumption growth parameters, it's degrown by 25%. So that is impacting the latex product for us. So therefore, our export has a latex share, and that share has significantly come down. That's where we have lost lots of business as compared to other traditional rubber chemicals market.
I think that, again, to clarify, that's more a market degrowth that's kind of playing out. Yeah.
Sure. And any specific number that you can give? I mean, how much does latex account for in your overall exports?
25%, yes.
Okay, sure. Thanks.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1. Anyone who wishes to ask a question may press star and 1. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. I hope I'm audible.
Yes, Rohit.
Yeah, thank you. So first question is in terms of the tire capacities which are getting added in the Indian context. So I believe in the next 2-3 years there will be significant capacity addition which is happening. How are we placed in terms of product validations? Because I understand that we've been telling there are 4 different parameters in terms of product validations, and that puts us competition at bay. So where are we for those newer tire capacities in terms of our product qualifications or validations? Thank you.
So as far as the domestic markets are concerned, again, qualifications, and this is also applicable for export markets, where it's an expansion in an existing plant, there is not any new qualification process. I think it's only when it's a new plant where you really have a qualification process. But typically, like we have mentioned, if we are already present with our other plants, then this process is kind of fast-tracked. So it's much lesser. It's not the usual 6 months to 1 year, but it's kind of well-timed with as and when those capacities are coming on stream.
Right. So second question is, if you, Srini sir, if you can give the absolute number of exports during first 9 months in terms of revenues and the similar number for last year.
Yeah, just a second, please. It's just kind of.
Sure.
The absolute number last year for 9 months is about 400 crores exports. This year we are at 350 crores.
Right. Got it, sir. So one more question in terms of sequentially the costs have come down. So this is primarily because of the variable cost regarding our volumes, the OPEX.
It's a combination of some volume level of operations as well as some price improvements in some key raw materials.
Right, sir. Got it. Thanks for answering all the questions, and I'll come back in the queue. Thank you. Best of luck, sir.
Thank you.
Thank you. Reminder to the participants, to ask a question, please press star and 1. The next question is from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, good morning, sir. So I think in your presentation, you have mentioned that you expect volumes in Q4 to improve sequentially. So are we expecting that to reach Q2 level or surpass that level? Any quantification around that?
So that would be, we do see an improvement over Q3, but difficult to put a finger to say whether it will be at Q2 or better. Yeah. So I think definitely there is an improvement that's expected. Yeah.
I think we're looking at 117. We may be nearing that or better than that.
Yeah.
Okay, got it. Second question, sir, if you can comment on the realization side. I mean, you mentioned that it has been coming down. So, so how do you see this from here? And on the value addition part, do we expect that to reach, 49-50% as we were targeting in couple of quarters, or you think that's slightly far away?
To answer this question, I think we have been trying to understand the price regime. So what we are looking at, the absolute value addition per kg or EBITDA per kg is what we are focusing on, rather than getting into the percentage basis, because ultimately the base level which we are comparing on a particular period A and particular period B, the base level may change. So therefore, you have to look at the absolute EBITDA per kg is what we are focusing on. What we are getting the feeling is that we have been giving guidance that always look at an average performance for a year rather than getting into quarterly performances. So by and large, we see for FY23 the full year around the same level for FY22 average, just around that level, adjusted for volumes, whatever that.
Okay. And FY24, do we expect to remain at FY23 level, or how do you look at it?
Yeah, so again, given the environment on how the prices have operated, I think we have kind of seen a good position in Q1 of this year and Q4 of the previous year. So difficult to put, but at least we would imagine that it should be at a stable level going into the next year at this point in time.
Okay. And sir, any take on the value addition part?
On value addition, Srini? Yeah.
I think we actually answered the question that we are focusing on more EBITDA per kg than getting into specific value addition, because ultimately we have to look at the total cost of operations rather than getting into segment wise. So we prefer to look at EBITDA per kg is that the driving point.
At the same time, we expect volumes to be better. Yeah.
Okay, got it. Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. Next question is from the line of Ravi Mehta from Deep Financial. Please go ahead.
Yeah, hi. Thank you for the opportunity. I just had a question. Realization for instance, you had guided
I'm
that.
sorry to interrupt you, Mr. Mehta, but your voice is breaking, sir. We are unable to hear you clearly.
Hello, is it better now?
Yes, please go ahead.
Yeah, my question was more pertaining to the realization that you guided in last quarter that you are seeing pressure, and it's visible in the Q3 numbers. Just wanted to get some sense, how is this scenario panning out with the whole China opening that we are hearing? What kind of realization pressure or the dumping stress that you are anticipating, is it playing out? It's better than what you thought, or some color on that?
Yeah, so when we look at this situation with China opening up, we do see the trading margins to be at similar levels. Yeah. And also I think there are a lot of other variables playing out in terms of demand increase in the downstream industries for some of the chemicals, for the raw materials. So it's a pretty dynamic situation, but our expectations, at least the trading margins will hold here.
And probably the mix, because of the latex market degrowing, that is impacting our realizations more in this quarter vis-a-vis a normal price pressure in the overall rubber market. Is that a fair understanding?
Yeah, it's really not, the latex market is not the major contributor. It's overall price development that's moved downwards here.
Okay. Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the follow-up. So any understanding on the new products which are currently under development? So we've been saying on this in the last couple of years. Any progress on that front and visibility in terms of when those products can be commercialized? Thank you.
Yeah. So the new products we are talking about are some localization products which are already at approval stages at most of our customers. We expect business to begin sometime in quarter one of the coming financial year, quarter one, quarter two of the next financial year. While there is more work in the pipeline, but still in the testing phase, Mr. Nagaraj.
And these would be apart from the auto segment. I mean, the catering segment would be different than autos, right?
Largely, since you still have critical volumes on the tire, it would be largely in the tire applications, which can then always be cross-pollinated into other rubber applications.
Right. Got it. And the recent volume, in terms of the inventory destocking that we have experienced in the global market. So is it also a function of Chinese volumes being higher in the previous period, and those now have been, the destocking is because of that sense, or probably because of the supply chain issues due to war kind of situation, the tire companies had stocked up significantly?
No, so when we went, we were talking about destocking in the international markets, and that was more on account of the overall sentiment of the recession, and that's what actually played out. So with the customers, so when you speak to them, they do tell you that there's a bit of they want to keep the inventories low, foreseeing lesser demand. But I expect that that's kind of flattening out now.
Sure. Thank you so much, sir.
Thank you. Reminder to the participants, to ask a question, please press star and 1. The next question is from the line of Chandragupta Arya, an individual investor. Please go ahead.
Hello, am I audible?
Yes, Mr. Acharya, please go ahead.
Okay, yeah, thanks. Thanks for this opportunity. Sir, my question, I just have one question about the export market specifically, and all this talk about China plus one that has been going on almost for a couple of years now. So can you share some information on how many new customers or new plant locations we would have added in the last couple of years, as a result of this shift to India, China plus one phenomena? Anything you can share?
Yeah, okay. Your voice broke a bit, but let me try and respond. And in case I've not, please do kind of repeat your question in case I've not answered. But let me try. So basically, like we mentioned, as far as global customers are concerned, we are actually present with most of the customers, and we have approval with most of the customers. It's about expanding from one plant to another, and what we have seen is there is traction, that's gaining traction about the intent to this China plus one, the back of China plus one, to approve us at more plants, and that means that gives us the opportunity to start selling into those plants from one period to another. So that's what is happening. So it's not necessarily, so since we're already present with most of the tire companies, it's not that we are adding a new tire company in the last few months. We are present with them. It's about now expanding into more number of plants. That's how it's working. Yeah.
Okay, but I mean, is the number substantial, or can you put some number, or at least qualitatively you can share? Is it very high or very low or something of that kind? I mean, how do we know, that when I mean, you mentioned that right now there is a slowdown of demand in the European market and all, but assuming that the situation improves, then what gives you the confidence that our volumes will also improve correspondingly? So I'm looking for something from that point of view, actually.
So we expect that with NOCIL's position, the increase in volumes will come from replacing current business of competition. So that's potentially something that we expect. And while I'm not able to give you a specific figure to this, but clearly we are talking about large companies which are out in the international markets here.
Okay, thanks. Yeah. That's all from my side.
Thank you. Ladies and gentlemen, to ask a question, you may press star and one. The next question is from the line of Inderji Moria from Anvil Research. Please go ahead.
Good morning, sir. And so I have two questions to ask. So one is on the conversion cost. So when we analyze the volumes and convert it into per kg basis, I think on a sequential basis, we are on the similar levels to what we were in Q2. So if you can just help us explain, like in between the conversion cost, do we see some sort of benefits coming to us predominantly in terms of, let's say, freight cost or power cost? And from NOCIL's point of view, how do we see our conversion cost going forward? So one is the operating leverage benefit, which will come definitely when our volumes would improve. But from internally, what we may be working on to reduce our conversion cost, if you can walk us through, that would be helpful, sir.
Gentlemen, if you see the other expenses of the financials which we just released yesterday, there is a reduction of 10 crores thereabout in absolute terms.
Correct.
It was to 100 crores, it has come down to something like 91 crores.
Correct.
It consists of utilities and other fixed costs. Obviously, utilities, we will make an effort to improve further or optimize definitely as we go along, and as we improve the volumes, operating rates, definitely some optimization benefit is in the offing. As far as cost, I think generally it goes with the inflationary trends. So once the volume increases significantly, I think those fixed costs, despite being in inflationary pressures, will be there. But I think the optimization benefit, definitely you can get something out of it.
Correct. But sir, when we see our power costs, so last year predominantly the cost increases were significant when we compare the FY21. And in the 9 months also, those power costs were elevated. But have we seen some signs of improvement in Q3 where our per kg cost for power, despite of lower volumes, has seen some sort of improvement?
Absolutely, we don't have any, the power rates have not seen any change. It is still flattish or marginal movement here and there. We have not seen any great thing. What we are looking at is whether we can improve on efficiency as we ramp up the capacities.
Correct. The second question is on what Mr. Anand alluded in the previous remarks, that we have been working on some new products where the volumes or some initial volumes would start coming to us from Q1 and Q2 of FY24. So if you can just help us explain that what could be the opportunity size for those sort of volumes in India, and is there a market for the export also for those new products which we are currently working on? And are those products having more realization than our existing basket of products? So if you can just help us.
So the volume, this product actually has scope both in the domestic and in the international markets.
Yeah.
They are part of our accelerator product line.
Okay.
And accelerators per se are much lower volumes, in terms of consumption in the rubber compounding. So we don't expect any significant jump in volumes, but the opportunity is there both in the domestic and international markets. I would say from a margin point of view, similar to our existing portfolio. Yeah.
Correct. But let's say out of our total rubber chemical size of, let's say, 11 lakh tons globally, how much this, so let's say 35-40% would be accelerators, if I am right. So out of those accelerator basket of products, how much this would be? So could it be to an extent of 15,000-20,000 tons of volumes globally for these products which we are currently under working stage?
But it will be lesser than that. These are more niche accelerators. It will be much smaller. Yeah.
Okay. Sir, last question is on, you touched upon on the export side also. So on your opening remarks, we mentioned that we expect a significant improvement in our export volume. So if you can just slightly elaborate more, like where we are currently. So those approvals which needed from all the tire customers globally and from various plants of those tire companies globally, have we gone through for most of our validations from the customers, or we still have to receive some of the approvals before which those volumes would start seeing the improvement once the destocking and everything is over?
Yeah. It's not kind of start-stop kind of situation. It's all at different stages. So we have already approved in the last 4 to 6 months in additional number of plants. There are quite a few already in advanced stages. Some of them are in close to completion again. So it's all at different stages, and again from customer to customer, depending on the number of plants and where they would like us to be present. That's where we are playing. So I would say it's on a fast track, but at different stages. Yeah.
Correct. And sir, just a last bit of understanding on the export volume. So let's say whenever we will exhaust our full volumes from now to whatever the timeline which it could happen, what will the mix of those export volumes go? Let's say if we are here to improve our volumes by, let's say, 30,000-40,000 tons hypothetically. So what could be the mix of those domestic volumes as well as the export volumes in those incremental volumes which would be coming to NOCIL?
Yeah, so when you look at incremental volumes, we do see that a major share will be coming in from the export, like we had mentioned in our earlier address.
Yeah.
So from a split point of view,
overall we will be looking at exports 40% at the peak capacity levels.
Okay.
Our overall revenue parameters.
That's for the overall business.
Okay. So this you are talking on volume side, correct?
Yeah, volume and
40%.
value.
Yeah.
Got it, sir. Thank you, sir. Thank you for answering the questions in detail, and all the best.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks again for a follow-up. So in terms of RM imports, currently how much is the percentage, and which and all are the key products that we import? Raw materials, not products. Sorry.
So, Rohit, I think we are changing our strategy in terms of raw material procurement. I will not be able to give you a percentage, but I think the objective is to shift more in terms of local purchasing. And I would say we have very successfully done it in key raw materials. And the endeavor will be to develop more and more local suppliers.
Right. Actually, Dev, I was going to come on that itself, that whether the suppliers are actually going in for those import substitute products in terms of raising their volumes, so we can be catered from the domestic market instead of relying on the imports incrementally. So this is a good sign. Thank you so much, sir.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Chandragupta Acharya, an individual investor. Please go ahead.
Yeah, thank you once again. One question, can you share what is the cash position now as of 31st December, and given that we have no major capex in the offing, is there any plan to increase the cash payouts, or what is the plan for
Gentlemen, we can give as of 30th September, the cash is about 150 crores.
That is 30th September, not December, right?
December we are not allowed to publish, so we have given as of September, which is at 150 crores.
Okay. And any plan to increase the payouts or something? What is the future plan for utilization?
We are working on that. Some evaluation plans are being worked out. At a suitable time, whenever we finalize, we will get back to you.
Okay, thank you.
On the capex front.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. reminder to the participants, anyone who wishes to ask a question may press star and one. As there are no further questions, I would now like to hand the conference over to Mr. Dev for closing comments.
Thank you. I take this opportunity to thank everyone for joining the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with me or Strategic Growth Advisors or our Investor Relations Advisor. Request all of you to be safe under given circumstances. Thank you very much.
Thank you. On behalf of NOCIL Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.